Inflation is stubbornly refusing to toe the RBI line. Figures released this evening show the consumer price index moderating just a little in February despite the tightening in the monetary policy. The CPI figure came in at 6.4%, just 8 basis points below the Jan figure of 6.5%. The food inflation clocked in at 5.95% versus 6% in January. The RBI has increased repo rate 6 times now in the past 10 months. That's a whopping 2.5%, trying to bring down the inflation rate to its target of 4%. The CPI clearly still remains sticky. My colleague Sakshi Batra spoke to Siddartha Sanyal, Chief Economist, Bandhan Bank, about the significance of the latest figures and the impact on the RBI monetary policy.
So we have seen the headline number coming down at 6.44%. Your take, was it as per your expectations?
Yes, actually, indeed, this is slightly softer than the previous range. We were expecting the number to be a tad further softer at around 630. Compared to that, this is slightly higher, but broadly in the same zone. So 10-15 basis points here and there, but broadly it's in the same zone. The important thing is that even though the number is slightly softer, it's a slightly tricky situation because this is again second consecutive month where the number is beyond the upper tolerance zone of the MPC.
All right, we are yet to get all the other figures as far as the breakup is concerned for the food inflation number. In fact, that is now coming at 5.95%. Now, this is just like a tad bit above the 5.94% number as well. Now, we do remember that, you know, the month of February has been the hottest ever in the last 122 years or so. Could that have impacted this slight uptake? Is it, or was it expected to be lower, but it has actually jumped up on the back of the heat that we have seen and the impact perhaps on the Rabi crop? Your take?
Rather than looking back, I think it's more important to look forward from this point onwards. That not only February was the most warm month in many years, but at the same time it's very important that this time we are talking about an El Nino possibility this particular year, and that means there is a possibility of slightly less optimal rainfall during the course of the monsoon season, where the weather plays an even more significant role. My sense is that in the month of February, the Rabi crop, just because February was a little hotter than expected, it didn't really have so much of an impact immediately. But a much more important question is what is in store from particularly from May, June onwards for the next 4 months. I think that's very important because that will set the tone for the Kharif marketing season, Kharif crop season, or the summer crop, which is the main cropping season. I think that particular focus will be very important.
You also mentioned about the monsoons, and you know that's going to be an important factor that may determine the food prices going forward from here. Everybody has been anticipating the El Nino weather pattern that usually results in the below average rainfall, cutting yields, pushing up food prices. Now, in case that were to happen, as is the expectation by most of the economists and from the IMD and the weather forecast teams as well, what could be the likely impact on food prices? Could we need to brace up for a huge bump up right there?
Oh well, I'd expect that the impact may not be that severe if we get a relatively better spatial and temporal distribution. If it is concentrated in some of the months, especially during the sowing season or in the early parts of the cropping months, then it's possibly a much bigger problem. But it's the deficit, if it is say something like a 5-10% kind of a deficit, the impact is not that severe. We do have an early warning, so that should help the croppers to plan better. Also, we have decent amount of food grains in store. So if everything remains in terms of how they are being projected at this moment, I think the impact is relatively manageable. But the problem starts when the food rainfall shortage becomes something like 5-10% is one story, and once it crosses that particular level, so 10-15%, then the impact is not really linear. So the key question is whether we have a relatively more even spatial and temporal distribution, and whether the deficit is capped within something like a 10%.
We've seen the Silicon Valley Bank collapse, really impacting the stock markets worldwide in today's trading action and over the last two trading actions as well. That will that have an impact on how the Fed will really move on rates? The kind of impact that we are seeing on the banking system, the financial system in US, is that getting also impacted because of the constant rate hikes, the aggressive rate hikes that the Fed has also been doing? And could that in turn have an impact on the RBI's move going forward too?
Certainly, Sakshi, as I mentioned a few minutes back, also that given that there is certain question marks at this moment about the functioning of some of the banks in the U.S., there is a bit of a question mark or doubts about how exactly the Fed stick to the course that they had indicated just a few days back. You rightly mentioned that on the basis of the inflation numbers, they wanted to be somewhat more hawkish and they wanted to act a little more sternly. But at the same time, if there are more uncertainties about the stability of the financial system, typically any central bank would have to be a lot more cautious before delivering further rate hikes or liquidity tightening. I think to some extent, Fed might actually would have to take that particular aspect into account. And there is no point, ignoring the fact that the Fed's measures and monetary policy steps had been having a huge bearing over the last several months over global rate trajectory, including most emerging markets, including India. So
Right.
that way, if the large central banks go a little slow in terms of their fight against inflation down the course of about a week down the line, that will be very important indicator for all central banks, including the Indian central banks, also to take a note of. At the end of the day, each country's monetary policy is based on its own parameters, its own inflationary pressures, currency movement, and all other factors. But in today's situation, there is no opportunity of missing the indications that come from the global arena as well. And RBI will also they have always balanced beautifully amongst all these parameters, and there is no doubt this will be taken into account going ahead in April also.
If you like the video, do like, comment, share and subscribe.